Our next guest says in the coming weeks he's looking for a 5% drop in the S&P 500. For more on the technicals, let's bring in Jonathan Krinsky, Chief Market Technician at BTIG. Normally, you point out seasonally September and October see some weakness, and the market managed to continue to move higher. And so you think that at this point we may be due.
Yeah, hey Joe. So this year has actually been almost inverse to what we typically see seasonally speaking. If you go back on a typical year, and this goes for average years and election years, you see some weakness in February and March. This year was very strong. Typically, April is one of the better months. This year was quite weak. And then you typically see strength in July and August. And this year, July was weak. It was actually the first down year for the NASDAQ 100 in July since 2007. And then that strength typically sets you up for some weakness in the September-October period, especially in election years as you get those pre-election jitters. And this year we've been quite firm in September, October. And so, the setup here is we think in the coming weeks you're going to get that shakeout. If we don't get it pre-election, which you normally get, that would follow that pattern of maybe a sell the news situation, kind of opposite of what we saw in 2016. And the other, the reason that we think this shakeout is coming is really stems from the macro cross-asset volatility we've seen. We just saw the largest move in the dollar and decline in bonds we've seen in the last couple of years. And if you go back the fall of 22, the fall of 23, when we saw similar velocity moves in the dollar and interest rates, those led to 19% and 11% drawdowns for the S&P. And we're sitting here about 1.5% drawdown. So it just seems like the equity volatility isn't really matching the macro at this point.
I was thinking about 2016 too. I think overnight, weren't we down 800 points on the futures, and by the next morning after the election results were known, we made that back, and then the market went up for like 6 months. Didn't it?
Yeah,
do you remember that?
You're right. We were limit down that night. And if you think about the setup, we're kind of week into the election. I think this year, with the market is in some ways pre-trading. I think, Trump is the favorite by a lot of, if you look at some of the betting markets and the way the bond market's trading. And so I think the setup is a little different here. I think, you could get that inverse reaction. Either candidate, if he wins, I think it's been pre-traded, and if Harris wins, there could be some disappointment there, given what the market's pricing in right now.
And you don't normally see this type of volatility in bonds, foreign exchange, and then complacency in stocks. You think that's trouble? Does that mean you think you could park some money in fixed income to avoid this, or since you think stocks will be higher by the end of the year, you just ride it out?
Yeah, I mean, that comes back to your time frame, and you're right. The markets rarely are concerned with the absolute level of interest rates in the dollar. It's almost always about the magnitude and the magnitude of the move we just saw over the last 2 weeks. Again, we've only seen that the fall of 22, the fall of 23, which again were pretty meaningful drawdowns for the S&P. So I think you could get a little bounce in bonds here. But that's and that probably is a little bit of a better play over the next couple of weeks than stocks. But yeah, I think stocks do have a little bit of catch down to what bonds and the dollar are kind of telling us here.
What's gold indicating to you?
Yeah, I mean, gold's tough here because we've been proponents of precious metals all year. Up until recently, they've been actually surprisingly outperforming stocks by a wide margin as of the last couple weeks. And I think as of right now, it would be gold's best year since 1979. So when we look at gold in the very near term, it also looks quite vulnerable to us. Again, gold has a pretty high correlation or inverse correlation to real interest rates. And real rates, saw a pretty sizable surge of the last couple weeks. And again, gold has not flinched either. We also have gold about as wide above its 200-day moving average as it's been over the last couple years. And I think sentiment is getting a little bit overconfident in the gold trade. So it's similar to stocks. The trend is up. The long-term trend still looks good, but I think you have to be a little bit careful chasing strength here over the coming weeks.
So what would the gain between where we are right now and the end of the year and the S&P, what would that translate into, even if we do have a pocket 5% or whatever, 5% plus downdraft, then it comes back and closes higher. What's left for the S&P this year? 2%? 5%?
Yeah, I mean, that's a good question. I mean, I think 6,000 is a level a lot of people throw out there. We tend to not use overall targets on the upside because the trend, you want to kind of let that ride. But I think, if we get that shakeout down around 5,600 in the S&P, which, certainly is not much, in the scheme of things, but it would feel, I think, if it happened over a week or two, that would feel kind of sharp. And then, I think you could go back and make marginal new highs, maybe get up to that 6,000 level. I think that's pretty reasonable.